What's up YouTube? Wall Street Bros back with another YouTube video for you guys today. Today we're going to be going over my overall thoughts on the market right now and how it's, in my personal opinion, how it looks in the future. Just to let you guys know this is not financial advice and this is just what we're thinking personally and what we are doing personally in the market. All right, so first things first, we got to talk about the federal funds rate. So before COVID was going on, the market was fine. There was no reason to raise or lower them, so it was pretty steady throughout 2019 at around 1.55. Once COVID hit, the market closed down. Everything closed down as the people started to quarantine, so they should put it down all the way to 0.05. Now this is a huge drop off. This drop is about 1.5, which is a huge change in the federal funds rate. So another basic thing about the federal funds rate is that the banks loan money from the federal government. So this rate here, 1.58 before COVID, is you have to add 4% to that to make up for the bank's interest rates. So the bank's interest rate at this time would be 5.58, for example. Now, when the rates are lower, as they are here down at the bottom after we got this crash in March, as they lowered the rates really low. So this, for example, this would be 4.05 in April for the banks. And now this interest rate makes people want to loan out more money and invest more in the market and just in general as well. So as you can see, with this huge decrease in the rate, people were more inclined to invest their money. And as you can see here, it stayed pretty steady throughout the whole rest of 2020 at under zero point 0.1. So we go to the next page right here. It's CNBC. This is a good article, and I'll leave the link in the description below for you guys to read if you guys would like to. But the main topic in here is that the interest rates rose. The federal interest rates rose to 1.11. Now, on the previous website, I just showed you guys that it was sitting at around 0.08. So this is a huge jump from 0.08 to 1.33, which is causing the pullback in the market as people are less inclined to loan out money and to invest their money in general as the interest rates are getting lower. All right, and if you scroll down further down to the bottom of this document right here, we can see that they have a higher increase of a forecast of 1.7 and an increase in year over year. This means that by the end of the year, they see it being at 1.7, which is still another zero point 0.4 increase in the coming years. All right, now we're going to be talking about how this affects the market and the Nasdaq. So we're going to go back a little bit in time in 2008 when we had the market crash there, and as you can see, that's right here. We had a decline right there, and we're talking about another example of this is the COVID decline right here, as you can see right there. If I can get it, there we go. So back in the 2008 market crash, as we can see here, this is a more drastic and more a quicker crash than COVID was. But you can see we saw the crash in 2008 right here, and we saw the steady rebound of when they lowered the rates. So the rates were lower here. They saw that it's starting to get up to the maximum point where it's starting to get up pre-crash. So they raised the rates again, and as you can see, we see another decline right here. They started to level off and gain support at this support rate, and then it's continued its uptrend again. So what I predict is going to happen with this crash right here, as you can see, we'll go in closer to this right here. So as you can see, here's the crash in March all the way down to the lows. We had no interest rate at all at this point, all the way up on this uptrend. So once we get to this uptrend, and we did hit all-time highs, so they're gonna raise the rates just like they did. We're gonna see a little bit more of a downtrend, and then once we gain that support level, which I think it will take to the end of March, maybe into the middle of March, we will see that uptrend begin again once we hit that support level of the whole market. Now going back to this Google Finance graph of the market right here, we have hit all-time highs this month. We'll go into the month view right here. We hit all-time highs right here. As you can see here, this is 14,095, which is the highest that the market has ever been. We actually even got up to 14,175, which is the highest the market has ever been because the interest rates were so low and everybody was bullish on investing in the market at the time. But I do believe that we won't see a complete market crash after this because of the interest rates, especially because they're more involved with the interest rates this year because of COVID and they have to really be on top of what the market's doing. I do believe that we'll see a correction of about probably 5 to 10%. As we see here, we're already 1.6% in. And I do believe that this will be over by the end of the month. Not to say that every single day from here on out will be red, but I think in the overall scheme of things, like in this month view, we will see a decrease of about 5% in the upcoming month from February to March. All right, guys, so our plan during this little pullback or correction in the market, we're going more on longer term stocks instead of doing these short term stocks, which are being hit really hard right now. So we're investing in Apple is one of my biggest ones I'm still holding. We're in Givo still, and then we're in a couple other ones. If you guys want to go check them out, go click the link in the description below to go find out our full thesis and our long holds. And yeah, make sure you guys, while you're down there, hit that subscribe button and that like button really helps us out over here. I'll see you guys in the next one.